So this market continues to drop. When I run the screens in the morning, I'm getting a lot of downward bias ideas, because a lot of companies are just in a major downtrend. That said, it seems like this sell-off is just a little long in the tooth. So my dilemma, the problem that I have is I anticipate that I'm not saying that this is the bottom, all right? So I'm not saying, there could be more downside left. But what I am saying is that I'm anticipating, given where sentiment is and just these oversold readings, that there could be a bounce in here, higher. So I'm trying to position the portfolio to get some long bias ideas in there to account for that upcoming reflex rebound, we'll call it. But I'm just not getting any. So I have to wait for this thing to kind of level out. In the interim, I was positioned, the portfolio is positioned to the downside, so I'm continuing to take profits on the stuff that's working. And I'm hoping to be able to beef up or build a little bit of long bias into the portfolio. I just got to wait for the right signal. So what's going on here? We went over in the last video over the weekend where the potential downside could be given this head and shoulders formation. So 38.20 to 38.50 would represent a bear market. It's down over 20% from its peak. But that said, here's the market making new lows today. The RSI, this is a bullish divergence, right? So the RSI is not making new lows to where it was, the previous low. And also the MACD is also not making a new low. So if we can see some kind of support maybe come around this level, and this level here being as a 50% retracement from this, from the October lows, the October 2020 lows. If there is some support here, maybe this is, could that be the neckline of this head and shoulders, here to here? Yeah, so if there's some support here, we could definitely see a bounce. Sentiment is really nasty, so let me go over a couple of things here. So take a look at the Aai survey. So this is a survey. They go out and they ask their members, are you bearish, are you bullish? This is a contrarian indicator, so when there's extreme bearish sentiment in the stock market, that's usually a good time to buy. So you can see right here, the last lows that we hit were, this was, I guess, October of 20, and we were all the way down here. So this is the bull to bear spread, right? So there's going to be not a lot of bulls here and a lot of bears here. So this number comes down to under 0.6, and that corresponded with this market bottom here in the S&P 500. So that was a pretty good buying opportunity. You can see we're even lower than that now. So sentiment is really nasty. You can see here, this is the bullish sentiment reading, this is the bearish sentiment reading, and there is a lot of negative sentiment out there, which is a contrarian indicator. Leads me to believe that we could get a bounce somewhere. This is Aai Survey. This too is at extreme lows. You can see we hit the lows here and here. This is back in 15 and early 16, and that corresponded with this market bottom in the S&P 500. This here corresponds with this market bottom here in 2011, and then of course we had the market bottom in late 08 to early 09, and that ended up being a good buy point. So we're here, 2 standard deviations below where it normally averages. So again, leading me to believe that all this negative sentiment, which is a contrarian indicator, would lead me to believe that there's got to be some kind of recovery in here. Doesn't look like it today. S&P is down 1.4%, Nasdaq's down 0.9%. All right, so let's look at the VIX. The VIX now all the way up here at 36. Term structure has gone inverted, so that means that the spot is higher than the future. That's usually an indication that there's a near-term bottom in place. This is the 5-day rate of change, pretty aggressive, and this put-call ratio all the way up here north of 1.3 just a lot of fear and a lot of negative sentiment in the market. Now, I'm not saying this is the bottom. I'm not saying that the bear market or the potential bear market is over. We have a big week. I think the Fed is meeting this week, so there's going to be a lot of news to digest. But what I'm saying is that I think there's going to be some kind of relief rally within the next couple of days or weeks. So I want to position the portfolio, get some long bias in there to try to account for that. All right, so what do we got going on today? Let's go to our trade list. I took half of this off, so I was long the puts. Let's take a look at what we did. Let's go to data filter. Ticker symbol. Tech. All right. I took half off, so we ended up buying. We only bought 3 of these contracts because they were a little expensive, but I sold 2 today. I bought them for $28.10. These are the $400 strike price, and I sold them today for $42.50. That's about a 51.2% return. Not terrible. You can see the remaining contract is now up 62% as the stock continues to come down. So we took half off there. Another one that I did today. So Moody's. We were long the puts on Moody's. Or did I move it? I moved it to the closed positions, right? So Moody. Here. So we were long these puts, and they reported earnings. Let's see what we got here. MCO. News. Right. So Moody's first quarter profit drops with dip in revenue, higher expenses. Not a great report according to the market because this stock now is down about 7%. So we were long the put, so that worked in our favor. So let's see what we did here with the Moody's. I took them off. MCO. Yeah. So we had bought the puts. These are the June 17th expiration. Strike price $330. We bought them for $14.70. We sold them this morning for $38.30. That represents about 161% return. I'll take it. Taking profits in a down market like this. I just got filled on another trade. The trade that I just got filled, which I don't have updated, is NEWR, New Relic. Just got filled as we're on the phone. NEWR. So here we had, I had closed out half the position. So we had the June 17th $70 strike price. We bought them for $6.65. We closed out the first batch for $10.10. And that was about a 52% return. And it looks like we just did the second half of that trade. That's the June 10th $70 strike price. We bought it for $6.65. We just sold them, looks like, for $12. So that's about an 81% return. So I'll take that. The straddle on the net that we had. That was Cloudflare, I think it is. Cloudflare. We had the straddle in place. I took off the straddle today because they're soon to expire. We had a little bit of profits in them. So if we take a look at what we did, we had bought the May 6th puts, $115 strike price, bought it for $75. $9.75, and we ended up selling them today for $27.47. And then we went ahead and we had bought the May 6th 115 calls. We bought them for $10.75, and I unloaded them today for 47 cents. So in the end, there was a spread there, about $7,500, represents about a 36% return on the trade. we'll take it. And again, these were expiring this Friday, so I wanted to take that off. Another one I took off today was another straddle, was CVS. CVS. All right. Trade list. CVS. There you go. Had this straddle on, and you can see between Friday and today, stock really broke down. So let's take a look at what we did. So with the CVS, we had bought the May 6th expiring this Friday. We bought the May 6th 104 strikes. Bought them for $3.12, and today we sold them for $7.91. And we had bought the May 6th 104 strike. We paid $3.35. Today I had to sell them for 23 cents. So you can see the spread there. Excuse me. We made about 26% of this trade. So we're just trading the volatility in the name at this point. And the last straddle that we took off today was Costco. Costco, this is a straddle. I mean, the upper buy point should be green up here, but it just doesn't read on this chart. So anyway, came down within our green zone, took it off. Let's see what we did with Costco. Okay, this is only one contract because they were so expensive. All right, so we bought the July 15th $600 strike puts, and we paid $28.03. And then we bought the July 15th calls, $600 strike price, paid $28.62. So in the end, I bought the puts that we sold for $28.03. The puts that we bought for $28.03. I ended up selling for $80.44 today, and the calls that we bought for $28.62, I ended up selling for $6.19. So in the end, that spread represents about a 53% return on the trade. And again, I risk, these are expensive. I probably could have did two, get me up to like maybe $10,000 worth of risk capital, but it is what it is. I had a couple of new trades today. I did a straddle on McDonald's. So McDonald's, I ran a screen this morning, and I was looking for companies where their Bollinger Bands were just really narrowing. I'm looking for stocks that are kind of consolidating and looking to break either way. Let me see if I can overlay the Bollinger Bands here. Right here. So, just Bollinger Bands here. This is on the weekly chart. I did it on the daily. Anyway, so this thing has just been consolidating over the past few days, and I'm anticipating a break either way, up or down. So I did a straddle here, trying to, this is a market, this is a neutral strategy. So what we did, McDonald's, MCD. I went ahead and I bought July 15th puts, $240 strike price, and I paid $8.05. And I bought the July 15th calls, $240 strike price, and I paid $13.95. So we're down a little bit in the trade, but trying to capture that spread. TripAdvisor. Trip here. So this, I did a bearish put spread on this. Seems to be working in our favor. I needed to close below that's 25.05 at some point before expiration or on expiration. So if I go to Trip, all right. What I did here is I sold the May 13th puts with a strike price of $24, and I sold them for $1.04. And then I went ahead and I bought the May 13th puts for the strike price of 26. Bought them for $1.99. So I'm anticipating some downward bias in this name over the next couple of days and weeks. Did another one with Lowe's. Same thing. Oh, this is actually this is the bear call spread. So I'm anticipating that on or before expiration that this stock will be trading south of 210.32. So it's got to stay in this green area for us to collect our premium. So what I did here with Lowe's, what I did here was expiring for this Friday. You got 4 days left on it. I sold the May 6th calls, 210 strike price, brought in 90 cents, and I went ahead and I bought, as my protection for the upside, I bought the May 6th calls, 212.50, and I bought them for 58 cents. So that difference in that spread is going to be what we're able to make. Last trade for today. So this one was interesting. Let me take a look at Pfizer. So I did an iron condor here. Pfizer's reporting this week. Now, the implied volatility on the options were pretty significant. The implied volatility was up around like 95-96%. So if you use the formula, you take the implied volatility divided by the square root of 252, and that would give you what the expected next day range is, right? So this is plus or minus 6% based upon when they report tomorrow. So that 6% number seemed awfully big to me because I went on and I took a look at how this thing is traded in previous earnings reports, and you can see they're all well within 6%. So 6% move on earnings for this name seems to me very aggressive. So I don't know if there's something with the whole COVID and the boosters and the vaccines and all that. Maybe there's some type of pent-up news that's pending, but it just seemed to me like the options were priced too high. So I went ahead and I did an iron condor. So basically I'm expecting that Pfizer will remain in this green area after earnings. So basically I need to stay between 52.48 to the upside and 45.52 to the downside. And let's take a look at what we did here to make this work. So this is 4 legs to this iron condor. So the first thing we did is we sold the May 6th puts, $46 strike price for 62 cents. Then we went ahead and we bought May 6th puts, $44 strike price for 28 cents. Then I went ahead and I sold the May 6th calls, $52 strike price for 25 cents. And then I bought the May 6th 54 strike price calls for 11 cents. So you put all that together and you're actually capturing a spread should the stock stay in this range after earnings. And once they report, the implied volatility will continue to drop. So this would work in our favor. Time is on our side with this one. So we'll see what we get. And it gave us this gives us an expected what was it here? Max return. So the max return on risk is 23.8%. So again, I mean that seems awfully high for a stock that doesn't really move that much after earnings, right? I could be missing something. I mean, maybe there's something that I'm unaware of that's supposed to be released during these earnings to give this certain pricing, but I don't know. I mean, see right here, this was fourth quarter in 2019. It had a 5% drop, but never really a 6% drop. And the implied volatility was kind of like representing like a 6% move. We'll see. All right, so we went through the sentiment. We looked at the market internals. One last thing. Yeah, that's it. So that's the trades we have. I think tomorrow we'll look at some more sentiment indicators and see if we can try to derive if at least there's going to be a near-term pop, and try to adjust the portfolio to take advantage of that. All right, thanks.